Every 4 years, the spectacle plays out. Politicians take the stage, promising a golden age of stability, prosperity, and endless growth. They dominate the news cycles. But beneath the noisy surface of democracy, the true architects of our financial reality operate in silence. The central banks. They aren't household names. Their leaders don't seek public mandates. Yet these institutions possess a power that dwarfs any legislative body. They define the very supply of money. They decide which giants of industry are rescued, which financial institutions thrive, and which are allowed to fail. Through a series of policy adjustments, they can determine the cost of your home loan, diminish the value of your savings, or even trigger a market crash that consumes your retirement security, all without a single ballot cast in their favor. This is the compelling story of how a few key organizations attained unparalleled influence in the modern global system. To appreciate their modern omnipotence, we must begin in the 17th century. Europe was a landscape of perpetual conflict. Royal treasuries were perpetually empty, drained by costly wars and extravagant royal expenditure, leaving governments desperate for reliable financing. In England, King William III urgently required funds to prosecute his war against France. However, potential lenders were hesitant, recalling the Crown's history of financial irresponsibility. The solution emerged in the form of a new institution granted a unique and vital privilege: the authority to issue notes, paper instruments representing the government's debt. This marked a profound shift. For the first time, circulating money was not merely metal, but paper backed by the state's credit. The resulting Bank of England served a dual function. It became both the principal creditor to the monarchy and the key banker to the nation. The core realization was immediate: control the flow of credit, and you hold the levers of the state itself. This blueprint was quickly replicated. Though Sweden's Riksbank had an earlier start in 1668, the Bank of England's operational model became the global standard. Throughout the 18th and 19th centuries, central banks became integral to European governance, consistently providing the necessary credit backbone for imperial ambitions, military campaigns, and the burgeoning Industrial Revolution. The Napoleonic era solidified the connection between national security and finance. Napoleon's military machine was fueled by credit as much as by gunpowder. Critically, Britain's sophisticated ability to finance its massive debt through its central bank provided the financial resilience needed to ultimately defeat the French. Wars, it was proven, were increasingly won in the ledgers of central banks, not just on the battlefield. The Bank of England-backed pound sterling became the unchallenged reference point for the world's economy. The most transformative moment occurred in the 20th century, particularly in the United States, where the banking system was notoriously fragmented. Frequent financial panics, fueled by collapsing public confidence, were common. The most devastating of these was the Panic of 1907. When the crisis hit, the nation wasn't rescued by a government agency, but by a titan of private finance, J.P. Morgan. From his opulent residence, Morgan marshaled fellow financiers, compelling them to inject the necessary liquidity to halt the system's breakdown. A single private individual had stabilized American finance more effectively than the entire political establishment. For Washington, this was an unacceptable concession of power. America desperately needed a public entity with Morgan's operational capacity. The outcome, following years of intense, often secretive deliberation, famously culminating in meetings on Jekyll Island, was the Federal Reserve System in 1913. The Fed was deliberately designed to maintain political distance while remaining intimately connected to the financial elite. Its powers were vast, issuing currency, setting benchmark interest rates, and acting as the crucial lender of last resort. It became the nation's new financial heart, sanctioned by the state, but deeply influenced by private banking interests. Few truly grasped the sheer magnitude of power being institutionalized. World War I provided the first great stress test. The demands of industrial warfare were astronomical, far exceeding the capacity of taxation alone. Central banks stepped up. They aggressively printed money, issued monumental volumes of government bonds, and kept their nations fiscally afloat. The cherished gold standard, the historic anchor of currency, was effectively suspended as convertibility was abandoned. The harsh lesson was learned. In times of existential crisis, central banks will always finance the state. The creation of money became central policy, not merely a crisis measure. The post-war inflation crisis ripped through Europe. The Reichsbank, yielding to political pressure, printed the mark into infamous hyperinflation. The Weimar tragedy, while catastrophic, did not delegitimize central banks. It only underscored their newfound necessity for both stability and collapse. The Great Depression revealed their capacity for unintended destruction. As market speculation reached unsustainable highs in the late 1920s, the eventual crash in 1929 was compounded by the Federal Reserve's failure to intervene decisively. Banks failed en masse, credit froze, and mass unemployment followed. Economists continued to debate if the Fed's restrictive policies amplified the downturn, but one truth was undeniable: a central bank's choices hold the power of national destiny. Post-World War II, the goal shifted to global coordination. In 1944, the world's financial powers convened at Bretton Woods, New Hampshire, to design a new world order. The plan established the U.S. dollar, pegged to gold, as the world's reserve currency. Other currencies were anchored to the dollar. Institutions like the IMF and World Bank were created to oversee the system. At the core of this arrangement was a stark reality: the U.S. Federal Reserve and Treasury were now the undisputed center of the global economy. Finance was now inseparable from geopolitics. The established order fractured in 1971. Mounting fiscal demands from the Vietnam War and expanded domestic spending depleted America's gold reserves. Foreign central banks began exercising their right to exchange dollars for gold. President Richard Nixon faced a critical juncture: sacrifice the nation's remaining gold or dismantle the system. He chose the latter. On August 15, 1971, Nixon unilaterally ended the dollar's convertibility to gold. The anchor of Bretton Woods was gone. The world entered the era of pure fiat money, currencies backed only by government trust and managed entirely by central banks. The pretense of restraint had vanished. Central banks now held unlimited monetary flexibility, and they have used it. Consider the financial history of the last 50 years. In the 1980s, Federal Reserve Chairman Paul Volcker brutally hiked interest rates to nearly 20% to conquer entrenched inflation. This triggered a severe recession, but it successfully re-established confidence in the dollar's stability. The Fed demonstrated its willingness to use its power as a corrective hammer, reshaping the economy through a single, forceful policy. Then came the catastrophic global financial crisis of 2008. Central banks reacted with unprecedented measures. The U.S. Fed, the ECB, and the Bank of Japan collectively injected trillions in emergency funds to salvage banks and prop up collapsing markets. This process, termed quantitative easing, was a lifeline for Wall Street. For ordinary citizens and savers, it felt like an injustice. Near-zero interest rates and inflated asset prices disproportionately benefited the wealthy, punishing those reliant on fixed income. The 2020 pandemic accelerated this trend into overdrive. Central banks initiated money creation on a scale previously deemed science fiction. Bailouts, stimulus payments, and corporate rescue plans were all funded by money summoned with a keystroke. The combined balance sheets of the world's major central banks swelled to incomprehensible levels. The public justification was always systemic stability. The consequence was predictable: inflation, asset bubbles, and the silent acceptance that money is now whatever central bankers decree it to be. This is the non-negotiable reality. Central banks are not impartial umpires. They are the chief financial power brokers. They determine who absorbs the pain of recession and who receives the benefit of a rescue. They decide the life and death of financial institutions. They can inflate away public debt or impose deflationary suffering. Their choices affect your personal economics more profoundly than nearly any political vote. Their operation is shrouded in intentional complexity. Interest rates, term funding facilities, open market operations. This specialized jargon effectively obscures the foundational truth. These institutions create money and direct credit on a scale that utterly eclipses any private sector entity. Every intervention expands their mandate. Every act of printing to save a sinking market entrenches the system's dependence on their future rescue. Every bailout increases the market's expectation that another one is inevitable. The result is a global economy profoundly addicted to central bank support. The inherent contradictions are mounting. Governments assume they can run endless deficits because their central banks will perpetually keep borrowing costs low. Banks undertake greater risks, confident in the ultimate safety net. Investors chase speculative bubbles, betting on the so-called Fed put to shield them from loss. But history is relentless.
The credibility of the Bank of England was once tested. The Reichsbank imploded into hyperinflation. The Bretton Woods system ultimately failed. Every financial architecture, no matter its apparent power, eventually finds its point of fracture. What does this mean for your personal outlook? It means accepting that central bankers, not elected officials, are the primary managers of your monetary future. When they choose to inflate, your purchasing power diminishes. When they choose to tighten credit, your cost of living soars. When they bail out markets, asset owners win and prudent savers lose. It means recognizing that the entire global financial structure rests upon trust, and trust is inherently fragile. Should faith in the dollar, the euro, or the yen falter, central banks cannot simply print credibility. It means understanding that real resilience lies outside the system they control, in assets they cannot create at will.
Gold, productive real estate, valuable skills, and essential businesses. These are the assets that have endured every collapse of central monetary faith. The story of the central bank is not some clandestine narrative. It is explicitly written in the history of every crisis, every intervention, and every inflationary spike. These institutions were created to serve the state. They were empowered by war. They grew indispensable through crisis management. Today, they constitute the central nervous system of a financial empire that encircles the globe. They are not elected. They are not held accountable in the manner of a president or a parliament. Yet their quarterly decisions reshape your life more than any law passed. This is the profound paradox of modern capital. The individuals we never vote for control the money we absolutely cannot live without. If this reframes your understanding of power, consider diving deeper. The answers we seek are not hidden in the future, they are undeniably revealed in the past.